Okay, so section 2, getting started with credit. So our learning objectives, we're going to compare the types of credits and list and explain the advantages and disadvantages. So when getting started with credit, you should consider the various types of credit available and the advantages and disadvantages of using credit. So that's kind of your goal at the end of this section. So what types of credit can consumers get? So first of all, let's define a few things. Credit is the ability to borrow money and pay it back later. Again, the ability to borrow money and pay it back later. A debtor is the person who borrows money. The creditor is the person or business that loans the money out. And debt is money that must be repaid. So credit is the ability to borrow money. Once you borrow that money, you now have debt that you have to repay. All right. So what are some types of credit that you already know? Do you know any types of credit already? So I typed the questions are going to be in here instead of in the chat. So what are some types of credit that you already know? So credit cards, loans, those are types of credit. So these are the 5. Credit cards, charge cards, which yes, charge cards are different than credit cards, consumer loans, lines of credit, and service credit. And we're going to go over each of these on the next few slides. So credit cards, this is one that we're probably most familiar with, and what probably comes to mind when you hear credit. It is for me, typically speaking. So credit cards by definition is a plastic card linked to a credit account that can be used to make a purchase. Where a store account is a credit account that allows you to charge items or services only at that store or with that merchant. So I don't want you to confuse these with like store incentive programs or customer loyalty programs. So, you know, Safeway, Raley's, those have like customer loyalty programs or reward programs, whatever they want to call them. What are some stores that allow you to have a store credit card though? Do you guys know of any stores that allow you to have a store credit card? Okay. Not getting many responses, and maybe because we don't know. So Costco, yes, Costco has American Express, as far as I know, which can be used some other places. I don't know if they have their own credit card. They may now. I haven't looked into it lately. A lot of like the chain big store, like clothing stores like Macy's, JCPenney's, Kohl's, those have credit cards you can get there. One like Banana Republic, Old Navy, and Gap, those 3 stores are all the same company. So if you get a credit card at Old Navy, you can use it at Banana Republic or Gap. Home Depot and Lowe's, they both have store accounts where you can have a credit card just to use at those stores. And another definition here, revolving credit is an account on which the account holder can charge repeatedly up to a maximum limit. So if your limit, for example, is $1,000, you can charge $100 today, $300 tomorrow, $50 the day after that, and you can keep charging until you hit your limit. Yes, you have to pay it back and there will be interest, most likely, but that's revolving credit. You can keep using it over and over again until you hit that limit. So credit cards and store cards are both forms of revolving credit. Store cards are a type of credit card, but they can only be used at that store. Whereas your credit card that you can get from your bank is typically going to have a Visa or MasterCard logo on it, and those are widely accepted almost anywhere. Interest is charged on revolving credit card accounts, right? So these are both revolving credit cards, meaning you can keep charging over and over and over again until you hit your limit, but you're going to have to pay for it. And I already answered this question. Store cards are different than credit cards because they can only be used at that store. So that's it for credit cards. But then charge cards. I'm going to be very honest with you. When I first started, before I taught this class, when someone said charge card, I just thought that they meant credit card. There is actually a difference. Did you guys know there was a difference? Did you assume it was the same thing? I thought it was the same thing until I started teaching this class. So you're well ahead of me, even if you didn't know there was a difference before now. So a charge card is a form of credit card for which the cardholder must pay the balance in full by the due date. So on a regular credit card, say you charge $300 last month, you don't have to pay the whole thing off. You can pay your minimum payment or $100 or $200. A charge card, if you charge $100 today and then $50 and then $20, at the end of the month, however much you owe, you have to pay the entire thing. There is no minimum payment. Your minimum payment is the whole thing. With a charge card, though, if you don't pay the whole thing, again, you're supposed to pay the whole thing, you are going to have a penalty, a late fee. You're going to have a lot of charges, fees that you're going to have to pay extra. They may also suspend or close your account if you do not pay it in full each month. Charge cards often have annual fees with them. They do often have perks as well, which we'll get into the benefits of credit in a minute. Some regular credit cards have annual fees as well. So if you are getting a credit card, you do kind of want to shop around and know what you're signing up for. Like me, some of them have great incentive programs, but personally, I'm not going to pay to be able to use a card. That's my opinion. Some people get them. The most common charge card that is American Express, and that is one that is like the Costco one. I think a lot of people, I associate it with Costco as well, but American Express is a charge card that has to be paid in full each month. So with that, would you prefer a credit card or a charge card? Do you have a preference if you got to choose today? And why, maybe? And what are some reasons for using one over the other? And that might be why you would prefer one. So, okay, credit card, less pressure to repay, credit card to avoid the annual fee, and the less pressure to pay, I totally agree. I like the charge card in the sense that it has to be paid back in full, and it doesn't allow you to get in a lot of debt. But if you're smart with your credit card, there are ways to avoid debt as well. And if you don't, for some reason, you don't have the money you thought you were going to have that month, you could just pay part of it. So that's charge cards. Consumer loans. A consumer loan is a direct loan of cash made to a consumer at a fixed interest rate for a set period of time. So say you get a loan for $5,000. And so they're going to give you cash. But your interest rate is going to be set and your repayments are going to be set. So payments must be made regularly and there's no continuous borrowing. Like you get that $5,000 and it's a one and done kind of thing. And there's no varying payment amounts. You don't get to make a minimum payment. Your payment is set. So you borrow $5,000 and your payment is $2,000 a month. Sorry, $200 a month for the next 3 years. And that is set. Most loans will let you pay extra if you can afford it. And we'll talk more about that when we talk more about loans. I don't remember in what chapter. So that's a consumer loan. And then there's also installment credit, which is a type of consumer loan or credit used to finance the purchase of a single high-priced item through a series of equal payments over a set period of time. So very similar, except you're not going to get cash. Installment credits are a loan, and they are typically going to be used for like a car or a house. So those high-priced items, and if you buy one, again, your payments are set for a set period of time. Do you guys know, or what's your best guess, what's the standard length in years for a car loan and what's the standard length of years for a home loan? You would repay them.
Knock it off.
So what do you guys think? What's your guess? So what do you guys think? Gonna wait for a few more answers. How long do you think you would, if you went and got a loan for a car, what do you think they would say this is how long you're going to be paying for it? What about a house? A couple people have got it. Some of you are right on. A house is 30 years. That's standard. Yes, you can get 15 or 20, but standard is going to be 30 years. And a car, 5 years used to be the standard. 6 and 7 are becoming a lot more common. You can get a shorter length loan, but 5 was kind of the standard. But like I said, 6 and 7 are becoming more of a thing now. So if you go to buy a house, they're going to say, okay, your mortgage is $2,000 a month for the next 30 years or more or less. And then collateral is property that can be used as a security for a loan. So for example, if you're buying a house or a car, that is the collateral, right? They can foreclose on your house. They can repossess your car. They're going to take those things away from you if you stop making your payments. If you get a consumer loan where they just give you cash, you have to put up typically some sort of collateral. And maybe it's your car. It can't be your car if you're still paying the bank. But it's something that has value that they will come take from you if you stop making your payments. So a line of credit is different. It is a pre-approved loan amount that a debtor can borrow as needed with no collateral. So the maximum amount that can be borrowed is set. So maybe you're pre-approved for $10,000. There's flexibility knowing that you have this credit in case you need it, and no interest is charged on any unused portion of the credit line. So say you get pre-approved for $10,000. Again, no collateral is, knock it off. No collateral is needed because you have good credit in this case to get a line of credit. Say you want to remodel your kitchen or bathroom and you don't know how much it's going to cost. You can, borrow $5,000 and then maybe $2,000 because you have that credit in case you need it, but the amount is set. And then the other type of credit is service credit, which when I think credit, I don't even think of this, to be honest, but it is. It's a type of credit that is available. It's just kind of different in a sense from the other ones. So service credit is the ability to receive services and pay for them later. For example, utilities, the doctors or dentists, the dry cleaners. So utility companies, PG&E, right? You guys might have your Chromebook plugged in right now. The lights might be on. You might have your heater or air conditioner going. Then at the end of the month, PG&E is going to send you a bill and say, look, we provided this service and now it's later and you need to pay for them. They gave you a credit. They're honoring that you're going to pay for it. Same thing at the doctors or dentist. You go in, then they mail you a bill. Dry cleaners, you drop off your clothes, you go to pick them up. They are clean and ready for you, and then you pay for it. They performed that service before you paid for it. They are trusting that you're going to come back and pay. So credit can be awesome. It can also be pretty scary. So it's used for a variety of reasons and it can be used wisely, but problems come up when people don't use it carefully. And you want to make sure the advantages outweigh the disadvantages. And every scenario could be different. So what are the advantages of credit? So there are 5 advantages that we'll break down over the next few slides. So it increases your purchasing power. There's security, extra security, convenience, leverage, and benefits. So what's meant by these? Increased purchasing power. What that means is it expands your purchasing power and raises your standard of living. It allows the purchase of big ticket items and to pay for them over time. So most people, if they want to buy a house, most people don't have $500,000 plus just sitting in their bank account. It allows you to buy these things that you couldn't afford with the money you have in your account. Even a car, a lot of people can't just go pay $20,000 or more, depending on what kind of car you're getting, for a new car. So credit, it allows you to increase your standard of living and buy things that you don't have money for right now. It has extra security. It's safer than cash because cash can't be replaced if you lose it. If you lose your credit card, you call and report it lost or stolen, and your accounts are frozen, and you are not responsible for charges not made by you. They are very convenient. Credit cards are accepted almost everywhere nowadays. With COVID and all the concerns, people want touchless payment, or you can even prepay through apps. A lot of places don't even accept cash right now. And they do allow cash advances. I highly recommend it. Don't recommend it. I'm sorry. Don't pretend I didn't say that. Cash advances, I don't recommend them on your credit card. I think it is a terrible idea. The interest rate on a cash advance is much higher than your standard interest rate. So keep that in mind. Most things you can pay for with your card. You don't need to take a cash advance on your credit card. There's also leverage, which means you can withhold payment over disputed items. If you use your debit card and you already paid for it, it's more difficult to settle that dispute and get a refund. Where if you use your credit card, you just call them and say, hey, I'm disputing this. Yes, there's some legality to it, and we'll go into that later in the time frame. But while you are disputing that charge, you aren't paying for it. They're not allowed to charge you interest, and you don't have to pay for it during that time. So, you know, it might be 3 months where you're waiting on it, but if you use debit and it came out of your account already, it's a lot harder to get that money back. And finally, there are some extra benefits. So if it's a store credit card, you might get advance notice of specials that they have. And a lot of credit cards nowadays have incentives or reward programs like cash back, or they give you points. You can earn airline miles. The ones that offer you points, it's typically like if it's 1% cash back or points, for every dollar you would get 1 point, and then 1 point is equal to 1 cent cash back. So basically every dollar you spend, you're getting 1 cent back. And then you can redeem those either in forms of cash into your account, or sometimes they have different gift cards you can buy that are like you could spend $40 and get a $50 gift card kind of thing. So they do have their benefits. However, there are disadvantages of credit as well. So finance charges, reduction of future buying power, overspending, and identity theft are the 4 big disadvantages of credit. So finance charges, items on credit and items purchased on credit and paid over time end up costing more because of the finance charge. So for example, if your credit card charges 18% a year, that's 1.5% per month. They divide it by 12. So if you charge $1,000 and carry that balance forward, that means you didn't make a payment on it. Your finance charge for the first month would be $15. So if you paid it back after the first month, you're paying $1,015, even though it was only $1,000 purchase. And then every month thereafter that you don't pay that full $1,000, you're paying extra in interest on that item. So when you buy something on credit, you need to ask yourself, if it's only worth $1,000, how much are you really going to be paying on it if it takes you a long time to pay it off? And when we look at, like, we're going to look at car loans and home loans, you'll see that, and we'll see how much interest you're paying. And you're paying the bank. That's why they give you loans, because you are paying them in interest. So reduction of future buying power. So your future income is tied up by committing to payments on your credit cards, and you may not have the funds or credit available to purchase other items or services that you need later on. So as I was saying, for a house, say you buy your house and your mortgage is $2,000 a month for the next 30 years and you have a great job, but you are committing to paying $2,000 a month for the next 30 years. That's a lot of money that's already spent, right? When you get paid, $2,000 of your paycheck is already going straight to your home for the next 30 years. And so if something else comes up down the road, you may not have money to pay for it. In a home, sure, that's a high need. But if it's something that isn't a high need product and you use your credit card because you go to Starbucks today and then McDonald's tomorrow, then you go on a Target run, did you need all of those things where now you're committing to paying that credit card off and you don't have, and something else comes up to where you don't have the cash for it. Now you might have to use your credit card again, which leads to overspending. It's easy to lose track of how much you are really spending. So you can create a pattern or history of this, which results in a poor credit record. So, you know, you go run those errands and then you pay your credit card or a little bit of it. Maybe you don't pay the whole thing off, but so next month, and now you want to go to McDonald's and Starbucks again, and you have another Target run. But because you did that last month and paid your credit card, now you don't have cash to do it this month. So you have to use your credit card again. And it's really easy to make a bad habit out of it and get yourself in debt. Which I think is the biggest disadvantage personally of credit. It's where we see the biggest problems with credit. People get into credit card debt that they can't get out of. And then finally, identity theft. You do run the risk of having your account information stolen, which we'll talk more about credit card fraud in chapter 9. It's a risk, right? It's a risk with anything, but you run that risk. But so that's one of the disadvantages. There are many advantages, many disadvantages. You just have to look at the advantages and the disadvantages in every situation. Like personally, I think for a home, yes, great idea to get credit because, like I said, most people don't have that kind of money to just spend. Whereas you just want to go to Target because you need a few things or want a few things, or you're bored, or you're just looking around on Amazon, that's not necessarily where it would be the best choice. And I think that is it for our slides for today. Do we have any questions on any of this from today or yesterday or anything else?